Well, it easily could be called as the conference of the season. Yes, I'm talking about the Citi Investor Conference 2018. So to understand the tone of the conversation, what are the big global views, local views, how should one read into the earnings recovery? More importantly, the current sell-off in the market, is this peak of the bull market, or this is a good time to put money to work for those who always wanted to buy? You know, there was enough and more narrative 10 days ago that run for the hills, the sky is going to fall apart and this is a financial Armageddon. Is that true, or this is just a blip? So to discuss all that and much more, I have with me the top team of Citi. We've got Surendra Goel, we've got Manish Sukla, and we've got Jamshed. Gentlemen, thank you for joining us and thank you for inviting us to cover the Citi conference. We're quite excited about it actually. Surendra, I'm going to first start with the broader view. What is the messaging at this conference? Run for cover or put money to work?
Okay. So first of all, thanks Nikunj. So in terms of, again, I spoke to a few clients today early morning, okay, and the interest still remains high. Of course, there is a lot more volatility that we have seen this year. So compared to last year where we just saw the markets go one way up through the year. So there is volatility, and to that extent there is more interest. People want to understand if the blip is a buying opportunity or should you still patiently wait it out. So interest is high. Our view still remains that this is going to be a moderate return year. We expect single digit returns for the market by December of this year, which is the view which we have already put out. Globally, our view still remains that this is not the end of the bull market. In fact, we put out an interesting bear market checklist, which is saying that only 3.5 out of 18 indicators are flashing red, which essentially means that the bull market has more legs. So that's the global view we are taking, and in the context of that, India still positive, but yeah, for this year, a moderate return year, given the kind of spectacular returns that we saw last year.
So when we will look back 6 months from now, or maybe a year from now, do you think February 2018 will just look like a blip, or this is one time when you really need to reassess your equity allocation, because a lot is changing? Central bankers are normalizing their policy, bond yields are moving higher. You feel this will be a blip? We should not get carried away with all the global literature which is floating around about bonds doing something and equity doing something.
Okay, so I think I tried to articulate by saying that we are not really expecting the kind of returns we saw last year. But to that extent, I think people should look at their asset allocation and they should look at what kind of returns to expect. We don't expect returns to be spectacular this year. Okay, what we are building in is a 7-8% return into year end. Now, according to that, I think people will have to take a view of what kind of asset allocation to keep this year.
Manish, in your notes, you've mentioned that the cost of capital is going to go higher, yet you prefer private banks and NBFCs. Now, my follow-up question would be that if cost of capital is going to go higher, why do you like banks in general and NBFCs also?
So if you look at the universe in Indian financial space, private sector banks, at least the top ones, have consistently delivered strong balance sheet and earnings growth. And whenever they've come to raise capital in the market, be it in the form of equity or they are raising bonds, investors are more than willing to give them that capital. And the distinction between a private bank and a PSU bank just keeps widening with every passing year. So to that extent, wherever there is visibility on growth, especially in case of banks' operating profit growth momentum, those are the stocks that we like. And that's the reason we believe that private banks will do well. Relatively, NBFCs are in a slightly weaker footing given the way bond yields are moving up, because cost of funds will go up. So last 3 years, we've seen that every NBFC has went up. Probably it's time to distinguish. The point that Surendra was mentioning, that NBFCs across the board may not necessarily give you the same returns. We need to be a lot more selective in case of choosing NBFCs.
Now, when Surendra says that you should keep return expectations diluted, do you think banks and NBFCs will outperform the broader market, or they also will give diluted returns?
Maybe let me take that. So if you look at our India model portfolio, we do have private banks as a significant overweight. So that is the call we are taking, that these are banks which have been market share gainers, high quality. Of course, valuations are high because the quality is good and the growth is good. And we expect that compounding to continue. So we are still taking a call that private sector banks are overweight in our model portfolio.
You like corporate banks. Now we know that the credit cycle has not picked up. Banks are still focusing on the retail piece per se. The retail piece is getting more competitive, and some would argue that most of the retail banks are not cheap. So why do you like corporate banks when the high frequency data points are not indicating a pickup in demand?
So our preference for corporate banks is driven by, selectively for corporate banks is driven by two factors. One, we believe that we are probably at the bottom in terms of corporate stress. Incrementally into fiscal 19, we'll see asset resolution, and we are already seeing the first 12 names of the NCLT list. The top three, 4 names are very close to resolution. So once these resolutions kick in, you'll have provision write-backs and you'll have income recognitions coming in, which will help your earnings. I am with you that the demand per se is not going to come back in a big way, but you have inflation coming back, which will push up working capital demand. And given the way bond yields are moving, some of the demand which had moved to the bond market would again come back to bank borrowing. So we've seen that inch up in the system corporate loan growth as well. We believe that trend will continue. But our thesis on selectively adding overweight position on corporate banks is not premised on growth coming back. It is premised on NPA recoveries, and it is premised on your ability to recognize income on NPS, which becomes standard.
You know, I'm coming right back to you with that NCLT question, but Jamshid, this question is coming your way, and I'm sure a year ago when you would have interacted with your clients, they must have asked you only one word: impact of Patanjali on the consumer staples sector. But now for the moment looks like the worst of the storm for the entire consumer staples sector is behind us, because the volume growth for the quarter gone by was not bad.
So, okay, volume growth, if you take a step back, it was good for the quarter for most of our corporates, but you have to remember this was a demonetization quarter. So if you look at it on a 2-year basis, so go back and look at it on a 2-year CAGR, adjusting for the demonetization quarter, you still have volume growth, which is, I would say, in the low to mid single digits. Anywhere between 3% to 5% is where you would have on a 2-year CAGR. So that's not spectacular, but it is but I would say we are probably out of the woods in terms of the issues that we've seen over the past couple of years. So last year, which is FY18, you had GST, which disrupted things for the first half. Before that, you had demonetization, which disrupted things for the second half of FY17. So we've had, I would say, 4 quarters of wobbles for whatever reasons, and now you're kind of coming out of that phase. So definitely, hopefully things look better.
But are stocks pricing in all the good news? I was looking at a stock like HUL or even Colgate. The P multiples are nearing 40-50 times. So these are good businesses, but are these good stocks to buy?
So honestly, we are being very selective. We are not saying that these are good businesses, no doubt about it. They've weathered a lot of storms and that will continue, but we are not saying that they are good stocks. I mean, both the stocks that you mentioned at this point in time, we don't have buys on them. From a portfolio perspective, Surendra might want to add.
So let me just add here. So if you look at our model portfolio over the last, say, couple of years, we have generally tried to play the theme through some other sub-segments of consumer, right? Autos is something we have been positive on. Consumer electricals or durables, whatever you want to call it. So that space is again something we have been positive on. So what we have been trying to do is play the same thing with stocks where valuations are lower. Within the staple space, I have generally had a big underweight and trying to figure out proxies to play that space. So that's what we have kind of had over the last couple of years.
You know, one very powerful call from Citi, and you've been on it, is that you don't like IT as a sector. And there's a great mention in your report where you talk about high frequency data points which are not indicating that the sectoral revival is here. But when you see a stock like TCS trading at an all-time high, what are markets missing on? Are we missing on something, or markets are missing on something?
No, that's a very good question, and in fact, that is what the big debate has been since the start of this year. So I think you have to keep a couple of things in mind here. So while a lot of investors believe that the sector struggled over the last, say, 2-3 years, it's broadly underperformed every year practically, because global growth was slow and it's kind of picking up. Okay. Now the fact is, global growth, or particularly US growth, was not really bad even last 2 years. Jobs data has been good for 3 years in a row. And our negative view was always premised on the business mix. If you look at these companies, they still have a lot of legacy business where clients are taking money out of. And that argument still remains unchanged. Having said that, there was always this risk, because if you look at the end of, say, the October, November, December quarter, both foreign investors and domestic investors had IT as the biggest underweight. So we always knew that if there is a little bit of a hope-based recovery, people will chase, because they are big underweights. You want to cover your underweight because it really hurts performance in the short term, and which is what we are seeing play out. If you look at some of the data points which have been coming out, okay, you look at all the companies globally who have guided for this year, they are all talking of a growth which is similar to last year. It's not materially different. You have the large US peer which just guided in early February, they are talking of a growth which is very, very similar to last year. So where is the acceleration? So I think we'll really figure out in April when a couple of the Indian companies also come and guide. Okay, but at this point we still think that there is a lot of hope in these stocks, and the underweight positioning partly got covered, which is what has driven this outperformance. On the point about stocks being highs, honestly, every sector stocks are at all-time highs, and IT did play a bit of a catch-up in the last 2 months.
So where do you think, or which sectors do you think are at an inflection point, either in terms of earnings or in terms of a market share game or in terms of industry dynamics changing? Because the endeavor of any investor is to identify these sweet spots of inflection where markets are not bullish and businesses may be at the cusp of a turn.
Okay, so to be fair, in India we have had a few good years in the markets, right? So it's difficult to say that valuations are cheap anywhere, right? The sector which has possibly been the most beaten down, which is pharma or healthcare, even their valuations are not really cheap in any manner, right? So our view is in pharma, we are taking some selective stock calls which are a part of our model portfolio, where we are saying that, yeah, the sector has gotten beaten down and some of the franchises which are doing reasonably well have also been beaten down. So that's one space which we like. On the gas side, there are quite a few mid-cap plays where, again, this is not really an inflection point, but these are multi-year secular businesses where we think risks are low. They can continue to compound at a very healthy pace. Again, on the auto side, Jamshed could add, but we have a few good names, a combination of value and visibility. Okay, so those are the kind of pockets which we are really, we have a big overweight. Private banks still remains overweight. Those are the big overweights for this year.
Manish, most of the private banks are reaching that threshold limit for FI investing. Is that the biggest challenge, that you like the sector, but A, it's overowned, and B, the existing large players, they don't want to sell. So that does not really create enough elbow room or headroom for a new buyer.
I mean, that is an issue if you really think the government merged the FDI and FPI limits, right? So now the limit theoretically is 74%. So foreign ownership is really an issue only for 1 or 2 entities, but these are reasonably large and liquid names. It becomes an issue only for guys who are benchmarked to indices, where these stocks don't necessarily have weight because they have less foreign room. But other than those segment of investors who have, let's say, handicapped by their benchmarks, it's generally is not an issue yet.
If a client walks up to you after this interview and says, Manish, explain me the entire NCLT process. How will banks benefit? Is this process which is transformational in nature, or this is an important process, nothing will change in FY19? What is your sense?
So the thing is, the biggest question that we keep getting on NCLT is how is it different this time? Because over a period of years, we've had multiple laws to address insolvency in India. So there is still an element of skepticism, right? And that is the reason I said we need resolution of 2 or 3 large names from the first list of RBI for investor confidence to come back that this process is actually working. We actually have a stressed asset resolution panel tomorrow where we have 2 representatives from ARC, 1 law firm. So we are going to debate those issues. But the fact is, if you see the way courts have been proactive in giving the verdict, it's not taking a long time. The message from the system is reasonably clear that we want to make this work. And once we have the resolution of 2 or 3 large names, probably the confidence will come back. But I'm with you that as of now, there is still skepticism among investors that will it really work? Because in the past, we've seen that such laws have not necessarily worked.
Up until now, retail has been the great go-to space for bankers and for investors. If you bought any retail franchise, whether it's NBFC or private banks, you've made money. But I just get a sense that the retail space is getting very competitive. And the HFC companies, at least the big ones, are feeling the heat of some NPAs. So betting on retail, do you think from a 3-year perspective, both in terms of a trend and also in terms of a cycle, could that backfire?
So retail in terms of a segment growing strong, I think that would probably continue, especially as we discussed, corporate capex is not there on the horizon. And if you look at retail credit penetration in India, we are significantly underpenetrated by any benchmark. However, because of competition, the profitability may not be same as what we used in the past. So while you'll see the loan growth, it would be at lower margins. The question really is, when does the NPA, if at all, it come and hit us? The beauty of the entire retail credit cycle in India has been there's hardly been any NPA. As you said, there have been some nascent signs right now in housing finance. We'll have to wait and see if that actually spreads at the systemic level. What has changed in the last 10 years, let's say since Lehman crisis to now, is that the credit bureaus are working very well, credit scores are working, banks have implemented their internal scorecards. So that's allowing them to price the risk better, but it's a question of how long does the competition behave in a sane manner. So at least the way we stand right now, the NPA issue seems to be in very select pockets. We don't see it as a systemic risk, but that's a space that we need to watch out for. But in terms of growth, I think there is enough and more room for retail as a segment to grow.
Jamshed, is there a historical correlation between rising interest rates and auto demand?
A very loose correlation. There's nothing very significant, but I would say there's a very loose correlation, and it comes with a lag of probably 2 years or so. You see, the thing that happens is that when rates start to rise from the bottom, it's probably a positive sign because it means that the economy is picking up. So that is not an issue. So the issue that you have of rising rates, let's say right now, is not going to transpire into a cutback in auto credit, at least for another year, year and a half. It's when inflation starts going up even more, rates have already moved up 150, 200 basis points. That's when you start seeing a slight cutback in terms of credit. And yeah, I mean, the sensitive sectors which typically sort of go first is, I would say, commercial vehicles, followed by auto, and then finally two-wheelers, because the penetration of financing in two-wheelers is anyways very low compared to the rest of these sectors.
Is it getting difficult now to pick spots in autos, because you got Eicher and Maruti on one side, you got a Bajaj Auto and Hero MotoCorp which are languishing for a variety of factors, you got Leyland somewhere in between. So how do you view things for the auto sector, two-wheelers, four-wheelers or CV?
See, we've generally preferred, not always, but I would say for the last few years we've been running with a preference for four-wheelers over two-wheelers. So in our two-wheeler coverage, the only buy we have is Eicher Motors. Four-wheelers, we have buys on Tata Motors, Mahindra, Maruti. We had a buy on even Ashok Leyland till about 2-3 months ago. So we've generally had a skew towards four-wheelers, and I think that positive bias continues.
Sundar, how do you think the 2018 conference, apart from the fact that ET is covering, is different from 2017?
So as I said, I think, so one of the questions I get asked is interest low? Absolutely not. We have around 300 clients who have already registered here.
Is that a big number from last year?
Yes, it would be higher than last year. I don't remember the numbers offhand, but I think it's a number which is higher than last year. Corporate participation is as strong as ever. Okay, we have 2 days of meetings here, and then we go to Delhi, where we have a macro day. We have people from the government, experts, etc., all of them participating. So I would say interest is pretty high.
Normally said that a low interest is good news. That means bargains are available. If you have a high interest, that means cherry consensus wants to buy Indian stocks. Shouldn't it be the other way around? Low interest sometimes is good news.
Yeah, low interest sometimes is good news, I agree. Okay, but then low interest happens when a market does badly for a long period of time, right? Here we are coming off a good year. We finally have some volatility. Market is down 6-7% from highs. So people want to take, and this is not India. It's largely a global phenomenon. So people are kind of trying to reassess if something is broken, or is this a chance the story is intact and you kind of get back 6-7% is a time to buy. Okay, so this is generally a time of high interest. At least that's how I look at it.
So in the closing comments, I mean, for last 2 years, we've not had a macro risk, we've not had a volatility risk, and we've not had a political risk. Things are changing. Macros aren't great. Volatility is back, and after 6 months or maybe after 9 months, we'll start talking about 2019 general elections. So the way forward suddenly now looks like it's going to be very uneven form, according to me.
No, that's a fair comment, okay, which is what we have also been saying, that moderate returns for this year with some volatility, which is what we expect as well. I think the only thing I would maybe caveat there is last 2 years we have had a good macro, but earnings were not coming through. So I think it will be important to see how earnings come through, because this quarter, or the December quarter, was actually quite decent. Right now, one could argue it was the base was a demonetization quarter also. But even then, that quarter earnings growth was fairly decent, supported by materials at that point of time. So on the back of a 20% quarter, BSE 100 again has grown 20% plus. Okay, so if I think earnings can be the silver lining, we have had depressed earnings for the last 3-4 years for various reasons. Okay, so that is what could really be work on the positive side. Now the market is already pricing it. If I look at consensus, people are already building that number in. Okay, but I still think if it comes through, it will be taken positively, because for most investors I meet, one of the very common questions is, oh, you guys are always forecasting 20%, but it never comes. So if it finally comes through, I think it will be taken as a positive. So I think macro versus micro might be an interesting thing, Where macro is possibly getting tougher, micro might be more supportive this year.
But in general, Surendra, right now there is enough and more evidence to believe that the global growth is back and the global growth is real. I mean, who would have thought 2 years ago when we were discussing negative interest rates, we would be talking about inflation fear, right? I mean, this is a good problem to have rather than a bad problem to have. What about your portfolio alignment with global sectors? Let's say going aggressive on metals or going aggressive on exports. I mean, is that a theme which you think would surprise us?
Yeah, so on metals, we already have a small overweight, and again, we are stock specific there. Okay, so a couple of names, we have fairly significant overweights. In terms of the other export oriented sectors, IT services, I said our view is more around the challenges in the business, and we prefer to remain underweight at this point. Pharma, healthcare, we are selectively overweight. Okay, and then again, some of the stocks that we cover, other stocks, it could be, say, agrochem. Okay, so that's a part of our model portfolio. So we do have an overweight there. But the problem is some of those sectors are really small from an overall India perspective. So we do have overweights on those kind of names as well.
Manish, closing comments. Now, you like it, you don't like it. I'm sure everyone would be curious to understand the PNB scam. How would you take that question? Would you dodge that question, or you would be giving them a realistic picture that don't buy PSU banks, hard to really dissect them?
No, so our preference of private banks or PSU banks predates all of this. In fact, even when government announced the recapitalization plan in October, we had continued to prefer private banks to PSU banks, simply because we believe that the challenges at PSU banks will take some time to sort themselves out. Going specifically to the scam, obviously it is being investigated and they'll be finding out where the liability lies. But in the interim, till the time we've heard the final word on this, there will be a lot of volatility, and that is the question which investors are asking. So some segment which had become more optimistic after the recap announcement in October are wondering whether it's time to continue with that or no. But you are right that in the short term, till the time we've heard the final word from investigators, it is volatility, but from our perspective, it has always been private banks over PSU banks, because we believe PSU banks will take a long time to come out.
Whereas your corporate lineup is quite impressive. I was looking at this pick of, a list of speakers. It's a very, well crafted and very well, orchestrated conference. What is that one big thing personally you're looking forward to? Which is that one big speaker you would say, look, I want to hear this person?
Okay, so firstly on the 2 days of the conference, let me put it this way. See, when we talk to clients, in every sector there is some disruption. We are living in interesting times, right? Autos, Jamshed can tell you there are clients who are already starting to get worried about electric vehicles, right? Financials, fintech. Every sector you talk about, and what we have tried to do is we have tried to keep panels on some of this interest, like we have a panel on fintech and cryptocurrency, electric vehicles, ARCs, all kinds of. So what we have tried to do is address all those issues by having a panel discussion with a bunch of experts who can cover those. And then again in Delhi, we have a very good lineup, including the Finance Minister of India, who is also scheduled to speak. So we have a very good lineup of people all the 3 days. But the focus has been trying to address some of the concerns or some of the points where investors want more clarity on from a medium-term point of view.
Gentlemen, good luck. Thank you for joining us.